Welcome back to the Deep Dive. We take your source materials, investor presentations, earnings calls, press releases, and, well, we pull out the strategic insights you need, minus the hours of sifting through it all.
Exactly.
And you asked us to dig into Happiest Minds Technology's Q2 fiscal year 26 results. There's one standout point we absolutely have to unpack today.
That's right. Our mission, really, is to get under the hood of what's driving the confidence at this company. Because, look, these aren't just decent numbers. Management's doing something pretty unusual.
Unusual is putting it mildly.
They're extending their commitment to double-digit revenue growth for a fourth consecutive year. That pushes the target all the way out through FY28. That's quite a statement.
It really is. That's the hook, isn't it? You simply don't make a 4-year promise for continuous growth, especially not now, unless you got some serious high-speed engines you know you can count on.
Absolutely. It signals real structural belief.
So what specific numbers in these Q2 results actually back up this, well, extremely bold declaration? Where's the proof?
Okay, so let's lay the groundwork first. We need to look at the first half of the fiscal year, H1 FY26, because that sets the context, right?
Right, the baseline.
The key number showing that foundational health is that revenue grew a pretty healthy 11.8% year over year, and that's in USD constant currency.
Okay, 11.8% YoY for the half. Solid.
Yeah, and operating revenues came in at $129.5 million. That's 11.8%. It's the proof point that they're, well on track with their existing guidance already.
Got it. And zooming in on Q2 specifically, what did that snapshot look like?
So for Q2, revenues in constant currency grew 2.3% quarter over quarter and 6.7% year over year. That brought operating revenues in US dollars to $65.1 million.
Okay, and profitability, because growth is one thing, profitable growth is another.
Right, and that's where you see the structural health really shining through. Their H1 EBITDA margin landed at 20.8%. That's sitting comfortably right in the middle of their stated guidance range of 20% to 22%. Q2 specifically, EBITDA was 12,027 lakhs, which is a 20.2% margin. So consistent.
I did notice in the source materials, they put a lot of emphasis on adjusted PAT. It felt like they were guiding us towards that metric specifically. Why do that?
Yeah, they frame it as a, quote, more reliable profitability measure. Essentially, they want you to look past some of the noise.
Noise
Like non-cash charges, exceptional items, think amortization from past acquisitions, things like that. Stuff that can kind of distort the picture of how the core business is actually executing day to day.
Okay, so filter out the accounting stuff, focus on operational profit.
Exactly. The takeaway they want you to have is simple. They're hitting margin targets profitably through solid execution. Their adjusted PAT for Q2 FY26 was 11.0% of total income. It's meant to be a clean signal.
Okay, so the structural health seems confirmed. We've got the 11.8% H1 growth, stable 20% plus margins, but sustaining that for 4 years, extending through FY28. Isn't that a massive gamble in this volatile climate?
That's a really good point. I mean, the margin for error is thin, which is why the source material points very directly to two, let's say, less traditional initiatives driving this boldness. Ah, okay. Not just business as usual, then.
No. It's the explosive growth in their generative AI business unit, GBS, and a really laser-focused strategy on acquiring net new, high-quality clients.
Right, let's tackle that AI engine first. We hear so much buzz about Gen AI everywhere, but Happiest Minds seems to be actually turning that hype into dollars. What does GBS look like on the ground?
Well, the materials call it a standout performer, and the numbers back that up. It delivered, get this, 77.8% year-over-year growth in constant currency for Q2.
77%, wow.
Yeah, and alongside that, a very healthy 15.3% sequential growth. I mean, that rate of growth is just phenomenal, especially when you see other larger firms talking about muted demand or pilot projects.
So how are they doing it? How are they replicating this success? Is it just a couple of big one-off wins, or is there something more scalable going on? That's where it gets really interesting for me.
It is, and the mechanism they describe is quite fascinating. They've apparently standardized 22 distinct transformative AI use cases. These have scaled from concepts into repeatable, replicable projects. Okay, so they've productized the AI service to some extent.
That's a good way to put it. And this success, turning that novelty into a process, they claim has unlocked a projected GBS-led sales potential of nearly US $50 million over the next few years.
50 million pipeline from those 22 use cases. And crucially, is this complex work getting the price tag you'd expect? Are they charging a premium?
Absolutely. The source estate Gen AI projects are currently commanding a significant premium. We're talking 20 to 25% higher pricing over their standard rate cards.
Okay, and that's vital.
It really is, because that pricing premium is how they maintain that 20% plus EBITDA margin target in an environment where talent costs are high and there's inflationary pressure. It's not just nice to have, it's core to the model.
Makes perfect sense. Now, we do need to add the necessary caveat here, don't we?
We do, correct.
Yeah.
Despite that explosive 77.8% year-over-year growth, it's really crucial for listeners to remember GBS still only makes up 2.7% of the total Q2 revenue.
Right. Tiny slice of the pie, even if it's growing incredibly fast.
Exactly. The upside potential is immense, and that $50 million pipeline seems real based on their traction. But right now, it's a very powerful but small engine, not the main propeller of the ship yet.
Okay, so we've looked at the AI engine, but that 4-year commitment, as you said, relies on more than just tech buzz. What about the other pillar, that hunt for entirely new clients?
Right. The net new, or NN, client acquisition strategy. They actually created an independent sales unit just for this, focused solely on bringing in new logos.
And did that bet pay off?
It seems so. They added 30 new clients during the first half, H1 FY26. And importantly, these aren't just small grabs to boost numbers. They're targeting large, high-quality logos. Think Fortune 500, Fortune Global 1000 customers.
Quality over just quantity. And what's the potential value from these 30 new accounts?
Well, in H1, they generate about $9 million in revenue. But the projected value over the next 3 years is significant. They estimate a potential of US $50 million to $60 million from just these 30 clients.
50 to 60 million. That's another big pipeline number.
It is. And maybe even more encouraging. Over half of those 30 new clients have already expanded their work with Happiest Minds, adding multiple initiatives within just months of signing on.
That's a strong signal. Quick land and expand. Show satisfaction.
Precisely. It translates into more reliable, recurring revenue streams much faster than you might normally expect with new logos.
Okay, can you give us maybe 1 or 2 tangible examples? What kind of wins are we talking about here?
Sure. So during Q2, they highlighted a few key ones. There was a complex database modernization project for a Fortune 100 insurance company. Big name, complex work.
Okay.
They also secured a cybersecurity enhancement project for a global health tech company. And tying back to the AI theme, they're using Gen AI to refine quality engineering processes for a global information services company.
Right. So the theme is clearly complex, high-value digital transformation work, not just basic stuff.
Exactly. That seems to be the focus for the new client acquisition.
Let's pivot a bit now. Let's dissect where the revenue is actually coming from today across their different verticals and business units.
Yeah.
Because the traditional segments are still doing the heavy lifting.
Oh, absolutely. The structure still relies on their 3 core units. PDES, that's Product and Digital Engineering Services, is still the dominant player. It accounted for 81.1% of Q2 revenue.
81%, okay, the vast majority.
Then you have IMSS, Infrastructure Management and Security Services, holding 16.2%. And that leaves GBS, the Gen AI unit, with its high growth but still small fraction of 2.7%.
So that long-term promise looks good on paper, but where are the potential cracks? You mentioned BFSI, their largest vertical. Is the volatility there a major threat to this 4-year outlook?
It's definitely something to watch. BFSI is the largest vertical, yes, at 25.3% of Q2 revenue. And it did see a slight dip quarter over quarter.
Why was that?
According to management, 2 main reasons. First, some deals for their proprietary Artha banking platform slipped from Q2 into Q3 and Q4. Timing issue.
Okay, recoverable.
Hopefully. And second, they had a temporary ramp down from a large existing customer in the APAC region. Management anticipates recovery here too, but yeah, it's certainly a risk factor. Any softness in your largest vertical needs monitoring.
And what about EdTech? That whole sector has faced headwinds across the industry. How are they navigating that specific weakness?
Yeah, EdTech has been a challenge, shrinking for a while now. But management sounded quite confident, actually, predicting a decisive bottoming out by Q3.
Just waiting for the tide to turn?
Not quite. They aren't just waiting passively. They've actively pivoted their strategy within EdTech. They're moving away from some of the more troubled segments and focusing instead on serving stable institutions and universities.
A strategic shift within the vertical.
Exactly. For example, they highlighted recently closing a multi-million-dollar deal, nearly $3 million, with a leading management institute in Asia. They're building an end-to-end platform solution for them. So the focus now is on institutional digital engagement, where they see more replicable sales opportunities.
Okay, that makes sense. Adapt within the vertical. Conversely, it sounds like maybe Europe provided a bit of a bright spot.
It did. Retail and CPG showed strength, and that was boosted partly by momentum building in Europe. They mentioned a key multi-year deal using the Microsoft Power Platform for automation at a European food company.
Good win.
Definitely. But geographically, let's be clear, the Americas are still the main engine. That region provides 60.0% of Q2 revenue. India's next at 18.3%, then Europe at 8.1%.
Okay, good overview of the segments. Now that we've covered the financials and the market strategy, let's look inside. What about the internal health metrics, the operational efficiency that has to underpin that stable 20% margin?
Right, and this section, I think, reveals some really significant and maybe easily overlooked improvements in operational discipline. Total headcount was 6,554 people as of September 30th. But the real story is in how efficiently they're being utilized.
Yeah, I saw that utilization number jump quite a bit, didn't it? That caught my eye.
Yeah, it really did. Utilization improved to 80.7%. The source material notes this is the highest it's been in over 3 years. It was up from 78.9% just in Q1.
80.7%. Just to clarify for listeners, that means basically 8 out of every 10 employees who are billable are actively billing time to clients.
Precisely. That's a huge operational achievement. It suggests management has really tightened the screws on the delivery machine, converting their solid pipeline into actual build hours very effectively.
That jump in utilization provides massive operating leverage. That flows straight to the bottom line.
Absolutely. And interestingly, even the high-growth GBS unit, the AI one, is becoming more predictable operationally.
How so?
Its utilization improved sharply, too. It jumped from 48% to almost 62%. So as those GBS projects become more repeatable, thanks to those 22 defined use cases we talked about, the operational leverage there grows rapidly, too. That's essential if you want to make those 20-25% premium contracts really profitable.
Right. Predictability drives efficiency. And other internal signs look positive, too. Attrition, for instance.
Yes, internal stability seems strong. Trailing 12-month attrition moderated. It came down slightly to 17.4% from 18.2% the previous quarter. Less churn generally means lower costs and smoother delivery.
Makes sense. And client stability.
Continues to impress. They have 290 active clients. Get this, 93% repeat business. That's huge. And 86 of those clients are big names, Fortune 2000 or Forbes $200 billion corporations.
Okay. And financial housekeeping. Things like DSO.
Also improving. Days sales outstanding, DSO, improved from 91 days down to 88 days, quicker cash collection. And they declared an interim dividend of 2.75 per equity share. Shows confidence in cash flow.
Okay. One last point on the operational side. Management specifically addressed something external that gets a lot of attention. U.S. immigration policy. What was their take?
Yeah, they tackled that head on. They made it very clear that recent changes to U.S. H-1B visa policies have had, and I quote, no impact on the company.
No impact at all.
They emphasize their strong offshore-led delivery model. They just don't rely heavily on sending people on-site to the U.S. They noted they only sent 2 professionals on H-1B visas in the entire preceding 12 months.
2 people. Okay, that really underscores the resilience of their delivery model against those kinds of geopolitical or policy shifts.
Exactly. Minimal on-site dependence insulates them significantly.
So wrapping this all up then, what does this mean for you listening in? We've looked at solid H1 financials, seen genuinely exceptional high-margin growth from their new generative AI unit, and noted the successful launch of a net new client strategy that's already building a substantial future revenue pipeline.
Right, and the management team feels so confident in these structural shifts, the AI engine, the new client engine, the operational tightening, that they've taken that unusual step of extending their double-digit growth target for an extra year out to FY28.
The core narrative seems to be strategic investments are paying off through strong execution, utilization up, attrition down, new high-margin services scaling.
Yes, but this definitely raises an important question for you, the listener, to keep in mind going forward. It's the final thought we want to leave you with.
Okay, what's the key thing to watch?
The Generative AI Business Unit, GBS. It's growing explosively, nearly 78% year over year. Fantastic. But remember, it's still just 2.7% of total revenue, a tiny fraction.
Right.
So the critical next chapter for Happiest Minds is really about this. How quickly can they scale that high-growth, high-margin GBS segment so that it materially influences the overall company growth rate? How fast can they convert that projected $50 million pipeline into actual realized revenue? And crucially, can they do all that while maintaining the operational efficiency they've fought so hard to achieve, keeping utilization above that impressive 80% mark?
That's the balancing act. Scaling the new while keeping the core efficient. That is indeed the essential tightrope walk to watch over the next few quarters.
Exactly.
Thank you for joining us for this deep dive into Happiest Minds' strategic outlook and their Q2 results.